Hello and welcome back to Trade with Conviction. I'm your host, Neil Crosby, and I'm joined today by Michael Ryan, our freight expert. How's it going, Michael?
Good. Thanks, Neil.
Good stuff. And June Go, our senior analyst in Singapore. June, how are you?
All good, thank you. But when I talk to my colleagues and other market players, seems to be just a very dull and dead market right now.
Yeah,
hearing that from a lot of people as well. Do you get the same
thing
on
similar
the freight
vibes
side,
on
Michael?
freight. Yeah, just so I see there's talk of, I wouldn't call it a glut, but that at the moment there is quote unquote enough crude or enough products in certain regions. Well, I can tell you that the Atlantic Basin definitely has enough ships. So you're kind of feeling the same sort of market scenario across freight and products and crude.
That's a good one, because I was thinking back on, because you wrote about this week, Mike, I was thinking back all the way to the beginning of March, and I think as a group internally we had a conversation about, from a medium-term perspective, you're going to have less oil flowing, ships leaving the Gulf, and they will all head into the Atlantic to pick up oil, and freight rates will weaken. And that's basically what has happened, right?
Yes, that's what's happened over the last 6 weeks. And again, that applies to all your ship segments from MRs up to VLCCs. And a lot of them are in the Atlantic. And what we're seeing now is, for lack of a better way to put it, like when little kids play football on the pitch and they all chase the football, nobody stays in their lane or positions. If one region is earning more than another region, everyone ballasts to that region. And then all of a sudden there's this massive imbalance. And it's just been happening in the last 6 weeks. It's probably happened twice to the US Gulf Coast, and it's caused wild swings in freight rates.
Yeah. And the fun thing that's happening in the US at the same time is, because of this dynamic as well, we're emptying the US of oil inventory. And at some stage, its role as one of the solvers in this whole thing, max exports, is going to drop off because it will have to price up. So you'll get a slowdown in the number of cargoes that are actually needing exported as well.
Which is a little bit scary then from a bearish point of view for freight, because if the US Gulf Coast is at max exports, and I do see a steady stream of V's loading, it's not making a dent in the tonnage lists. So even though I'm seeing an elevated number of V's fixing out of the US Gulf Coast each week, I'm seeing a steady increase in the number of open V's out of the US Gulf Coast. So if exports levels start to come down, you're going to see quite the build in tonnage out the curve.
Yeah. And it's going to depend on the segment as well. I mean, we're jumping the gun here, but it's just whilst we're on the topic. What's happened is the Asians have locked in TI VLCCs. They're locking in kind of July and August loaders, whereas it's the Afras that are kind of loaded on a sort of shorter term basis. So what I've been saying is that the natural thing to happen will be that the demand for Afras to move to Europe will drop off, because it'll be the Afra arb that closes. And that's something that we've also seen in the last week or so.
Yeah, and I'm seeing that play out now. Just this week, I think the TD25, the recent rally, is done. Rates moved up a little too high. It helped close the TI arb into Northwest Europe. Afra counts I expect to lengthen, also just because there are already enough Suezmaxes in the US Gulf Coast. So if you have any ability to stem up, you would, just looking at the rates. And across the Americas, as we go into the larger segments for V's, there are more than enough V's all the way down the coast from Houston to Rio. Anywhere you look on the tonnage counts.
Happy days. So I guess it's lower ceilings for freight in this kind of context, right?
Yeah, and tighter trading ranges. Like I said, as people reposition their ships within the Atlantic, you can see little spikes and troughs in freight rates, but it's no longer a decision to reposition in the Atlantic versus the Pacific. It's a decision to reposition in the US Gulf, off the coast of LATAM, or WAF. So your ballasting options are much shorter timeframes than they were 2 or 3 months ago.
Very good stuff. So why don't we pick this up? Why don't we pick this up after our little intro section? So we like to do a bit of chat about what we've seen in the week. The US Apache was downed last night, I think by an Iranian drone. Last night, this morning, there's kind of direct exchanges of fire between the US and Iran again. I don't know what you guys think about this whole situation, but I have to admit, for a few weeks, I kind of refrained from reading too much about the negotiations, because nothing tangible was coming out of it. But I did see some really good commentary over the last day or two, which was linked to this trend of growing transits in and out of Hormuz, including the dark stuff, because what that represents is kind of a decline in the leverage that Iran holds over the region, right, in terms of oil. And whether or not it's been helped by the US guiding of vessels, I'm not quite sure, but certainly there's this trend of Iran's leverage on oil is slowly easing, and that seems to be kind of the US plan, right? This MOU is never going to happen, and the US is using this ceasefire period to actually bomb Iran in various places, but also to let this kind of easing of leverage story play out, and then they can bring back Iran to the negotiating table in a serious way down the line when their leverage is lower. So that's something that I thought was actually pretty cool. And the next kind of phase of that story will be, of course, the Iranians know this is happening, and what are they going to do about the trickle that is leaving Hormuz?
I mean, yeah, you're 100% right. It gives the US more negotiating power. Last I saw was basically 3.5 upwards to 4 million barrels per day, kind of silently transiting the strait and then STSing onto smaller ships. The US, as you say, I've not heard any announcements or anything really for the last month about transits, but it does seem like they're helping to facilitate this. Just in effect of, if an Apache was shot down by a drone directly over the strait, then in effect they are policing the strait somewhat, no matter what they say in the press conferences each day. So let's see. It helps the negotiations, and it also helps in a way give more time to the Gulf states to figure out how they're going to deal with all of this.
Yeah, well, we'll see. I still think it's to be traded kind of as is, should you have the expectation that we'll get another doubling of transits in the next month? I'm not sure. And basically, I wouldn't make a bet on that because, as I say, what are the Iranians going to do about this? Or what can they still do about it is another question. So we'll see. June, what about some data? PPAC came out, Indian oil demand.
Yeah, Indian oil demand actually up for the main fuels for May. What went down was LPG, not surprising, 206 kbd, naphtha down 81 kbd. Others category, bitumen and petcoke down about 200 kbd. But jet demand is essentially flat. Gas oil, gasoline and fuel oil slightly up by 20-30 kbd. And for overall net total demand reduction from India is now about year-on-year 399 or 400 kbd. How about in Europe?
Yeah, I mean, that's not nothing, but I am noting that it's really the petchem stuff and petcoke which is down rather than road fuels, but it's not growing as strongly as it did. Yeah, I wanted to bring this up on the Eurostat side as well, because there's lots of clients asking in about where do you see demand destruction. We've talked a bit about it over the last couple of weeks. The problem for us is that's not our core business for a start, right? But I do know from previous times that we're lacking in data still. So there is some early data for Europe now, and I think that was quoted in the Financial Times as well. So it's EU-wide road fuels declined by about 2% year-on-year in April, but it hides a bit of some nuance. So in France, there was a big decline in diesel and gas oil, of which a big chunk was also heating oil. And that's one of the points. That's a classic kind of consumer behavior as well. If you see the peak in diesel price, retail price, which is April, you tend to delay your purchases for refilling your tanks and stuff like that. So I'm not quite sure that April is the best indicator yet of demand declines. And you saw similar things in South Korean national statistics, right? There was a big decline in naphtha demand, which looks to be permanent because of the cracker situation. But there was also something like a 30% decline in South Korean diesel demand in April. And that is not something that's actually justified by price or economic activity, right? It's really, I think it's just a temporary kind of reaction to a spike in prices. So we'll see. And the STIO also came out last night. They think demand will decline globally this year by just 1 million barrels per day. And so far, it's telling us the demand destruction is about 3 to 4 million barrels per day globally in Q2, of which a massive chunk is also China. And we know that the Chinese numbers are very dodgy, to say the least. So we will find out. I still think we shouldn't get too bearish on demand yet. What about the Saudi OSPs, June? That was another one.
Yeah, so it's like a $10 discount for Northwest Europe and Med cargoes, $6 per barrel discount for Asia, and $2 off for US Gulf Coast. but nothing really eye-raising. Is per roughly market expectation. And also a small note that we did see OPEC Plus agreeing to the fourth hike of 188 KBD. Again, doesn't really matter much in this current situation until we get Strait of Hormuz back. Maybe I just want to go quickly on the global inventory update. So, Cushing stocks are now at 22.4 million barrels based on the 4th of June report. 20 million barrels is where the industry believes there's an operational minimum, and we could reach that by end June basis the 1 to 1.5 million barrels per day of drawdown rate. On the fuel oil side, we've heard VLSFO stocks in Fujairah reportedly at zero for the first half of June, with Alzo refinery only running 1 unit. However, a Suez of Dangote LSSR is on its way for a mid-June arrival and will require some blending before the real supply relief comes in Fujairah. This is actually a big change in the market because prior to this, the assumption was that traders didn't want to deal with shipping close to Fujairah, and then needing to blend and having barge operations all within firing range. We've now vetoed making that first step to resume such blending ops. We should see more doing the same going forward.
Okay.
Maybe the last one on the VLCC side. Again, another report that VLCC orders are now at record number. Currently, 262 VLCC orders on order at shipyards around the world, according to Clarksons. This number surpasses the prior peak set in October 2008, which at that point of time ultimately led to a glut and collapse in rates in the subsequent years. Last week, there was a big event in Athens for the shipping industry's biennial Poseidonia event, and that was one of the biggest talking points. And there was one good quote from one of the executive chairmen that the biggest risk that shipping has right now is rich ship owners.
Yep. Winter is coming several years from now.
Yeah.
You can feel it in the winds, in the trade winds.
So what do you mean, Michael? Do you think it's just
just
a long-term situation?
It's the shipyards have been backed up for years. So this order book of many VLCCs won't hit the market for several years. But you're right that when they start to add 3 to 4 to 5 to 6 VLCCs a quarter, starting few to several years from now, that will really impact the market. And given how we're having a geopolitical crisis roughly every 2 to 3 years, let's say 3 years from now, there's something else going on. And then all of the Vs end up in the Atlantic again. And now you're having 5 additional Vs leaving the dock each quarter, going straight to the Atlantic. I do think that could be quite bearish. But not yet.
Yeah, whilst we're on this subject, because what we are doing just now is we will be destroying some oil demand permanently, right? I mean, there's a big acceleration in like EV pickup and, desire for heat pumps and stuff like that. And every time you get another one of these crises, particularly one this size, you are probably destroying long-term oil demand. So those two things don't go together very nicely, I would say, for freight.
No, and correct me if I'm wrong, but a lot of the headlines I read about China's on the forefront of electrifying the consumer economy. They have some of the most advanced electric vehicles at some of the most attractive prices. So you're right.
Yeah, the funny one on China is that there are banks, let's say, estimating Chinese oil demand has already declined 10% through the crisis, which seems a lot. It does seem like a lot. Some of that will be permanent, I guess, but a lot will not. But yeah, in terms of the long-term stuff,
longer-term trajectory. Yeah,
for sure.
And June, you were just talking a little bit about demand destruction in a few different regions, and I just wanted to share that when I look at the fixtures over the last couple of weeks, say leaving Singapore, West Coast India, and the Far East, I see more diesel fixtures leaving the Far East now and generally heading towards Indonesia, Southeast Asia region, and in particular, still a steady flow into Australia. And maybe interesting, maybe not, but a lot of the fixtures over the last 2 weeks out of the Singapore area have been interregional. They're the sort of like 4 to 5 day voyages. And that's had a bit of an impact on freight rates, even though tonnage in the Southeast Asia region has been relatively tight. If you're just doing these interregional voyages, your ship reappears on the tonnage list basically as soon as it loads. Because if you're looking a couple of weeks out, most of these voyages return are not even 10 days.
So is that I presume that's also a direct function of the fact that kind of South Korean and Japanese runs are also rising, right? This is this whole story of these guys found more crude than we initially thought they would. The Chinese left crude for others, so to speak. And timing is a bit dodgy on that statement, but a lot of Asian runs forecasts have proved to be very or overly bearish, let's say, in the short term.
That's what I'm seeing a bit on the ARBs, but also just on the physical actual flows, continuing to see a lot of flows south into Australia. And even West Coast India loaders, the pace of the loading has slowed, but the long haul nature has not. I see gasoline cargoes into US West Coast, like Los Angeles and Alaska, and the ARBs lately over the last couple of weeks out of West Coast India have been wide open.
Good stuff. What about the rest of the clean market? So do you want to just give us the lowdown on what you see globally?
Yeah, so the US Gulf Coast has been quite volatile in regards to MR clean rates. The sell-off, the most recent sell-off finished maybe 10 to 14 days ago. And the market, TC14 market, started to move higher. Part of this move higher in TC14 has been somewhat artificial because your earnings out of Northwest Europe are so deep in the gutter that no owner wants their ship to open in Northwest Europe, because lately they've been earning less than 10K a day, where out of the US Gulf Coast, you could be earning on a longer haul voyage, 45, 50K a day, or Caribs type voyage, 70K a day. So the earning spread is quite large. So there's been this premium to get an owner to fix into Northwest Europe that has artificially caused your TC14 rates to move higher. Now, with TC14 jumping and general MR freight out of the US Gulf Coast jumping, that has started to already attract ballasters. So your WAF ballasters, your USAC ballasters that might have decided to go to Europe a couple of weeks ago are now indicating the US Gulf Coast. And their voyage times, again, since everyone's in the Atlantic now, they're starting to populate the back end of the tonnage list. So your third decade June is looking quite long tonnage. And with your quick spike higher in freight rates over the last week or so, it has shut almost all of the ARBs, not just into Europe, but into east and west of LATAM, etc. And freight at these levels is not sustainable. So whoever put 320 on subs, hats off to them. But I think freight rates really need to be more like 265 or so to start to reopen all of these ARBs, including your mainstay diesel into Northwest Europe.
Yeah, okay. So that's a good one for the HOGO when we're thinking about that, because we're kind of discussing where the HOGO goes, but the TC14 strength comes off would help some things. Okay, understood. Anything else on the clean side, or what about dirty?
So I'm continuing to see a steady flow of Vs getting fixed out of the Americas. Like when I look at Brazil fixing pace, I mean, there are several Vs getting fixed every week. And in a normal, non-global conflict type scenario, that number of Vs getting fixed every week would make South America very tight on Vs. But in effect, I'm seeing the count rise every day, even though we're seeing elevated fixture levels. And that same scenario applies to the US Gulf Coast and your Vs there. Even though we're seeing basically max WTI exports, every week more Vs are arriving, and there's just not enough cargoes to absorb all of this tonnage. And then your WAF grades, from a freight perspective, WAF has just looked a little bit boring. Like, I'm not seeing the number of Suezmax fixtures that I would expect. I'm not seeing the WAF grades price into Northwest Europe and the Far East like I would have thought that they should. And now that WTI looks like it's not pricing very competitively into Northwest Europe anymore, your demand for your smaller vessel sizes in the Atlantic just feels soft. Are you guys seeing the same when you look at it from the crude perspective?
I mean, on the
China
WAF
side,
side,
the WAF side is a China story, right? It's been about a month now. China basically did not buy any cargoes. In fact, they were reselling some of their WAF cargoes, and that's really dropped the premiums in the market. Initially, we thought it's going to be a once-off phenomena in the last trading month, but that habit persisted in this trading period as well. So demand for WAF really collapsed because of China.
Okay, that from what I see when I look at the relative basket indexes we have and just the fixtures over the last month, if I were to make a call on it, it looks like the demand from China is coming from Brazil. like it's getting filled by your South American grades. Do you see that on the landed values as well? Is that making sense? Like are LATAM landed values better than your WAF landed values lately?
On the whole, yes, there's some exceptions. There's things like Cabinda, which would normally be associated with China. But as we say, if they're not really buying, then it's kind of a tricky thing. The whole landed values thing is very difficult at the moment because for Arab Light's basically the only PG crude available at the moment, except in that quality category, let's say. Of course, there's Murban and Oman. But I think the whole traditional landed value view, including all the crudes that we normally monitor, is slightly tricky at the moment. But it does make sense what you're generally saying.
Just seems like a preference for LATAM grades, in particular Brazil loadings lately.
Yeah, I mean, the quality makes sense as well. Like generally heavier LATAM stuff. There's a reason also that the South Koreans are trying to lock in, let's say, TMX crude from Vancouver for the next year, because that's super heavy stuff that they simply require to replace some of the super heavy PG grades. So if there's a glut, it's always going to be the lighter, sweeter stuff in this kind of context. And WAF, to a certain extent, fits into that category as well.
Okay, makes sense.
June, what about the general state of the PG crude market? Seems a bit soft.
Yes, indeed. So let's recap. When we started the crisis, the market only had Murban and Oman available, loading outside the Strait of Hormuz. And then as all the reports are coming in, we heard more cargoes trickling out, hidden STS activities to bring more cargoes out. And therefore, more spot cargoes are being available. The big one that just came out is really the ADNOC cargo. They've awarded a sell tender last week for Upper Zakum, Das, and Lulu. This is for June to August loaders. Some cargoes were on FOB basis, some on CFR basis. The buyers were ranging from Vitol, Unipac, INEOS, Petronas, IOC, and SK Energy. Estimated 14 million barrels were sold, primarily medium sour UZ crude. And then they issued a second tender that will close tomorrow, June 11th, for these same grades. The offer is also basis FOB Fujairah storage, Zirku of Das Island, as well as STS in Fujairah to Sohar region, to Sohar range and Malaysia. On top of that, we have at least also 2 VLCCs of Kuwait crude reportedly offered to refiners in at least China and South Korea. Yeah, so I think we keep saying that the trickle might be it's not yet a gush of oil that what people are expecting, but it seems to be a small stream now. What do you think, Neil?
Yeah, it definitely it's partly the reason that I suspect the market's feeling so relaxed in general as well, right? There's kind of expectations that this thing will grow. If we say that it's sort of a incremental 1, 2, 3 million barrels per day of crude versus last month or 6 weeks ago, that's not nothing as well, considering all the other solvers we put in place. And so it does seem very significant. I don't know how it will progress, as we started to say at the start of this pod. And another thought that occurred to me was we saw the reports yesterday that what's happening on the Q8 side, for example, is that they're drawing from certain onshore storage sites very rapidly. So there's a question about whether they manage to draw the oil that's both floating and in certain locations, port locations first, and then are they really going to backfill that with supply? Because it's not going to be easy to raise supply, I suppose, trickle by trickle. It's kind of more of a trying to raise as much supply as possible at the same time. So we'll see how sustainable it all is, but for sure, it seems very substantial at the moment.
Well, in the meantime, with all this extra prom oil, we are seeing Dubai physical premiums drifting lower, now about $5.80 per barrel versus $9 in the last month of trade. China is still not buying actively. Even Iranian crude are being sold at a discount of $1 to Brent, to the teapots, where it was at $2 premium versus Brent in the last 2 months. We also have India well supplied with Venezuelan and Russian crude. So I think one of the questions that I had was, do we then see a higher premium for heavier crudes versus lighter crudes, particularly in light of the low fuel oil inventory in ARA and Fujairah? But we don't see that so much yet in Singapore. But the yield shift that we have been talking about for the last 2 months already, getting where crude refineries are now getting a lighter crude slate in Asia, is playing a big part now into these lower fuel oil yields. But because we have also alternatives like the Canadian heavies to Korea, India taking out more the Venezuelan crude oil, and Iraqi barrels coming out, Kuwaiti barrels coming out. So it's not a clear trade that heavier barrels will get a premium, at least in Singapore or in the Far East region. Yeah. On Russia, we do see quite a lot of crude exports. Why is it so? Number one, Ukrainian refinery attacks. And number two, seasonal refinery maintenance, giving us more Russian crude oil. So as a result, CAPCO and CPC has weakened. The CPC arb is wide open into the Far East against WTI and Murban. CAPCO has started to recover week on week, probably due to higher met runs ahead and perhaps some doubt about how much US SPR and Basra flow will hit the local market going forward.
Yeah, that's something just to note as well. They're talking about that in the context of Johan Sverdrup now as well. So both of your statements about the uncertainty around how much US SPR crude will hit Europe in the coming months are making a difference to Sverdrup and KEPCO, it seems. Plus the desire for low API crude, as in we're increasingly short resid. So the next bidding up of the physical market that should happen over the summer, all things equal, let's say, should be focused on things like Sverdrup, and we already see that in the Sverdrup diffs actually over the last week. So that makes sense to me. And yeah, as we've also been saying, generally speaking, it's not just US SPR crude that's likely to partly dry up. It's the whole kind of US crude complex. You can see it in the WCS diffs already. They're rising basically $1-2 per barrel per day at the moment, rapidly strengthening. That also is probably symbolic of the situation in Cushing, and also the TI arb to Europe. Now, I was just looking this morning, TI looks kind of semi-open again, but it looks like it's rather a freight story. So as you were saying, Michael, TD25 looks to have topped out already, and there's going to be a bit of a battle there. If freight is going to be weak because there's US crude drying up, we're going to have sort of these cycles of the TIR being open and then closing itself off again from the fundamental physical perspective. So it's an interesting little battle that's about to play out over the summer. But on average, I think it's justified to keep the TIR mostly closed or more closed than we've seen for a while. Shall we do a quick fire roundup? I'll go with distillates. What are we seeing on distillates? The Singapore regrade is rapidly strengthening. I think part of that is down to the Chinese export disappointment. So there was quite high expectations for jet exports to rise in May, and that just didn't materialize. So I've actually been kind of talking about being long the regrade for several weeks. I've been very early and therefore wrong, but it is playing out now in Singapore over the last few days. Europe didn't really do much yet on the regrade side of things. I think part of the problem is we've had some demand destruction. We've still got high yield. US jet stocks are still climbing, even though the yield is coming in as well. The interesting thing we were talking about internally was this story about ARA jet stocks. So those are exceptionally low. And we were wondering whether it's a good time to be basing a trade off of that, because what's happened is overall jet imports into Europe are low. And when that happens, you're likely to see some changes in the major import-export hubs. And that is what ARA represents. So maybe ARA isn't representative of the jet stock situation in Europe as a whole. But we note today the US jet arb into Europe is also quite closed. It looks like we're going to need TC14 to help us out on that one, which is what we're thinking about on the HOGO as well. And then on the HOGO, the only thing we want to add is as Michael was saying, the diesel MR arb from Houston to Europe is very closed. TC14 can do something about that. And in theory, that will help the HOGO cool. But the one piece of info we're looking for today is the PAD 1 stock situation, because the US diesel stock inventory situation has calmed down. It's been flat to slightly higher for the last 4 weeks, but PAD 1 has been drawing. And when you get a big critical situation in the pricing center like we have just now, another draw or maybe one or two more draws into expiry makes things very interesting from a HOGO perspective. So we're looking for that piece of data tonight. What about the light ends? Do you want to do that, June, or is that me?
I'll take that. So we are interestingly seeing gasoline arbs open from Houston and ARA into Botany Bay for end July arrival. The last time we saw that was at the start of the crisis. So I think what's causing this shift is we are seeing strong July gas east-west and also a higher freight cost from Singapore to Australia right now. But because the Southeast Asian markets are well supplied, I think it's more likely that the July gas east-west, which is currently at minus 390 dollars per barrel, will need to correct instead. For fuel oil side, we've seen the 0.5 east-west collapsing from extreme levels. It was trading at about 97 to $105 per ton as recently as the 3rd to 5th of June. Now about $55 per ton prompt. It is below the physical Rotterdam Singapore Suez freight cost. So the arb is effectively closed, and the east-west curve from N+1 onwards leaves the arb structurally short for the next few months. So we're expecting supply to thin from the west into Singapore from July onwards. On the Sing VLSFO blend margins, they are deeply positive across July, August, and September. Historically, with margins this elevated, it will self-correct either via a drop in physical premiums or a tightening of spreads. The question we have is, do we have enough components to make these blends? So if Singapore blend margins stay this high into late June without a physical premium response, watch out for the cash lift to start firming in mid-July as the August supply gap becomes more apparent.
Good stuff. So still roughly long VLSFO. Sounds good. Okay. Anything else, guys? We feeling good?
No, just I wanted to recap super quickly that I think your TC14 and TC2 earnings start to approach parity as TC14 sells off over the next couple of weeks, and gasoline and naphtha exports out of Northwest Europe are strong, and I think rates will gradually, mildly strengthen, and we start to approach that earnings parity. And then also just that I think the TD25 sell-off for Afras in the US Gulf Coast has more room to run, so I wouldn't catch that falling knife yet. And then just in general, there's too much tonnage in the Atlantic, and owners are ballasting, chasing wherever the higher earnings are. So just take that into account because it starts to swing things in one direction to the other quite quickly.
I like your analogy about the football pitch, especially we are going to World Cup right now.
Yeah, exactly.
Sounds good. Michael, are you expecting anything to happen from the World Cup in terms of a US performance?
No, it's always a letdown.
Yes.
And I'm not as excited as I normally am about this one. There's been so much talk about the price gouging and the ticket in the nosebleeds is over $1,000. It's not in the spirit of the global World Cup competition. You know, you really want everybody to be able to attend. Let's see.
Some mates of mine are going. They've got tickets to see Scotland Haiti, and it's $400 or $500 per ticket just to see Scotland Haiti.
For those two powerhouses. Yeah.
Exactly. Yeah. Happy days. All right, guys. Thanks very much, and thanks for listening to Trade with Conviction. Hope you guys have a good week of trading. See you next week.
See ya.
Bye.